Hey everyone, welcome to the Elite Real Estate Podcast. I'm your host, Sam Popple, along with my co-host, William McClellan. How are you doing today, Will?
Today's a good day. It's all good, man. How about yourself?
Dude, I'm excited because we get the other half of a great partnership of a previous guest we had. So today we're going to be interviewing Andrew Calloway. It goes by Milt. Milt is the co-founder of Southern Venture Partners. His professional background is in private equity investing, where he has sourced, structured, and financed and led investments in real estate and operating businesses. Additionally, he has operated operational reporting and investment performance measurement of 90 plus million in a private investment portfolio across real estate, private equity funds, and direct operating business assets. He's also an Air Force Academy grad, which is definitely really cool. Currently living in Houston, Texas with his wife and 2 kids. So without further ado, welcome to the show, Milt.
Oh, good. There he is.
There he is. A little technical.
Sorry, did it go through? I thought I spoke, but I don't know if it went.
No, you're good. Good. Welcome to the show, man. How you doing today?
I'm great, man. Thanks for having me. Like I was saying, thanks for putting up with Zach too. Sometimes that's hard to stomach. So,
man. Nah, dude. Hey, he was so awesome. We want to know who his partner was. So I guess now we meet the brains of the operation. You know?
Yeah. One half. I won't say which, but
right. No. Hey, look, you got a solid partner there. We definitely enjoy talking to him, especially with all his engineering knowledge and stuff like that. Just really cool guy. But man, let's start with the beginning with you. How did your journey in the Air Force eventually lead you into the world of real estate and private equity?
Yeah. Without getting too military-esque, it's an Air Force guy. I was not a flyer, and so if you're not a pilot in the Air Force, you're not CREP, so to speak, in terms of long-term promotion scale. So I think as I was active duty, I always envisioned that likely wouldn't make a career out of that. And so as an undergrad, always had an interest in finance. Now, the Air Force Academy isn't exactly in the business of producing corporate finance professionals, and so there was not a true finance degree offered. But between economics, kind of ops research, stats, tried to align myself well with where I thought I might end up in the private sector on the outside. So active duty, I started in the world of research and development, kind of contract and program management, and then try to do my best to kind of raise my hand and take any opportunity that came my way. And so was able to grab a lot of experience operationally as well down the line, some overseas deployments, some airfield ops, and some aircraft maintenance overseas. So felt like I got to see both sides of what I would call corporate Air Force and then operational Air Force, which was really what I was looking to do, understanding that I might not make a career out of being an officer. Wanted to experience as much as I could within our 5-year minimum active duty commitment. I didn't really know much about private equity. I mean, this is like early 2010s, right? So I didn't know much beyond maybe reading Barbarians of the Gate or basic Google searches at the time. What I did understand fundamentally was that private equity was in the business of investing in private markets, right? Businesses. And so what always interested me the most, especially being somebody who came from this leadership mold, leadership mindset as an officer, was I felt like in the world of investing, it would give me the best opportunity to work directly with teams, right? As opposed to maybe being a public equities analyst somewhere. I felt like that would be my best opportunity to apply some of the skills from a management and leadership perspective, along with the analytical skills that I had tried to develop over those early years and meet into a business model that allowed me to do both. When I got into private equity, I quickly realized that the world of finance is all shaped by public equities and markets, right? So if you don't have that strong fundamental understanding of how markets work, how our entire economy is shaped around kind of public equities and the trickle down effect into the things that we do in private equity. Your career in private equity is going to be very short. So the big learning curve for me, I would say, as I stepped into that private equity world, was really firming up my knowledge base around just how money, finance, markets all work at a real world level.
Yeah, that's a lot to take in. Now take us kind of over the course of the years in that transitionary period, and kind of what you were doing active duty wise, and how that allowed you to scale. Diving down a little bit deeper than that high level overview there that you just gave us.
Sure.
And following up with subsequent years, and kind of your, let the guests know who Milt is, and that journey, because that's always something that, at least whenever I'm listening to podcasts or getting to interview or talk to cool people, I always just want to know their story.
Yeah. A lot of private equity, real estate, any sort of investment profession is about underwriting, right? Technical skill sets of understanding how to price something, what you're willing to pay for that thing, and ultimately some estimate of what you think that thing will be worth in the future. And so as an Air Force officer, at least for my first 2 years, when I was more in the research and development side of the house, what I would call corporate Air Force, I spent a lot of time, frankly, running the equivalent of like government pricing models, right? So I was a cost estimator, which meant I was effectively underwriting defense contracts. Specifically, in this case, it was modernization programs in and around the F-15. So we were upgrading that platform as it became clear that we were going to need that aircraft for many years to come. So, like, just from a training grounds perspective, I would say that's the closest example that I could, or corollary to maybe a 22-year-old being an investment banking analyst for their first 2 years before they pivot into the world of, buy side an investment house. So, like, just from a core technical competency, it kind of started there. And as I mentioned, as an undergrad, I was really into ops research and stats. Got a lot of Excel time, and I was okay at it, so felt like that that would be something that I hope to apply down the road. Like, making the career transition was murky, right? So the way it normally works, I mentioned investment banking analysts. The way it normally works is, as an undergrad, you're a high-performing business or finance student, or if you're an Ivy Leaguer, you major in anything and get recruited by an investment bank or a high-end consulting firm. All of those are great training grounds, just from a technical perspective, right? You underwrite, you study businesses, you build business cases. So as I was making my transition, I don't think I had a firm enough grasp on exactly how the process worked to get into one of these investor seat roles, right? So Zach utilized the same program, but I was able to leverage what's called at the time, it was called Career Skills Program, which meant I stayed on active duty for 6 months. If I was able to go secure my own internship, the Air Force would cover my salary and benefits for 6 months if somebody agreed to let me come work with them, shadow them through an unpaid internship. So the closest thing that I could find to a real corporate investment banking job was through a business brokerage house. A business brokerage house is called the equivalent of, like, I don't want to offend any business brokers out there, but if Goldman Sachs is a Ferrari dealership, these are like used car lots, right? These are guys that are.
As someone who's been on both sides of dealing with those guys, yeah, I bought and sold businesses, and
Wait, so you're buying a Ferrari? No,
I'm with the Kia guys.
So, I mean, just slinging, like, calling business owners, trying to get them to sign up to sell their business. These are what you call sub $1 million EBITDA or net income businesses, like mom and pop, Main Street, kind of businesses. Again, like there's buyer universes everywhere. It's everywhere from individuals that are just looking to roll up or buy a small business, maybe a competitor that's buying a small business, all the way up. The surprising thing to me was all the way up the food chain to kind of large private equity, right? So in investing in private operating businesses, you've got what's called a platform business, which is your mothership. And then by and large, most private equity groups have roll-up strategies, right? So they're looking for any size company to acquire and roll up underneath that umbrella of a platform business. So when I got in, again, it was the closest thing I could get to true sell-side advisory work. I was not expecting to interface with as many large family offices in the state of Texas and an occasional like middle market private equity group.
Mm-hmm.
So as I was helping kind of sign these businesses up, run basic valuations, put together the SIMs, the investment memos, or the pitch decks, I kind of became the face of this little brokerage house for 6 months. These were older guys too that didn't want anything to do with underwriting or putting together marketing materials. Well, interacted with a lot of buyers. And as that started happening, I started to build pretty good rapport with some family offices in the state and a few private equity groups. So I was able to pivot from that internship role into the first family office group that I worked with in Dallas, because they came in on a sell side engagement that I was working on. Ultimately, they didn't buy any of the businesses we were trying to pitch them, but they did enjoy working with me, and they had an ambition to go build sort of a legacy holding company structure. The patriarch of the family had made some money in oil and gas, pretty typical scenario in the state of Texas.
Sounds like
looking to diversify into some other businesses.
Man, that's awesome. So I was about to ask you, how'd you make that transition from a defense into finance and breaking the private equity world? But it sounds like that was the road right there.
That was it. That was the first switch, and I was working with primarily the second generation of the family at that point. So 2 sons that we were all pretty close in age, and they had, a pot of money that they were trying to deploy, and had some ambitions and ideas about how they wanted to invest that money. And the primary objective was to buy like Main Street businesses, exactly the kinds of companies that I had been underwriting and supporting the sell side for the last 6 or 7 months before that. So felt like I had a pretty good grip on how we could go find quality businesses and how to interact with the business broker world. Because that's really, when you're at that level, go back to the analogy, like you're not competing on a broad process with a big investment bank when you buy these small businesses. Like there's a world of business brokers at every corner of every state that are out trying to help people sell their businesses. And very much like today, this was in 2018, there's certainly an increase in baby boomers retiring, those legacy businesses coming for sale, right? So the game was evolving and changing on the sell side as I was kind of in the mix there at the brokerage house. So a lot of deals to look at. There was a lot of opportunity. We did a good job of spending all the money that we had, and got to a point over 3 years where we had done a number of transactions, I think 9 or 10, somewhere in there. And like most good stories, I had met a girl from Houston. We got married. We were about to have our first child, and decided that we wanted to raise a family in Houston. So without much plans other than we need to get to Houston and I'll figure it out from there, had to make the tough decision to step away from the Dallas firm, move to Houston in time to have a first child, and then through a series of personal networking and just hustling where I could to get my name out there, was fortunate to be introduced to a much larger, what I would call more institutional family office in Houston, Jumana Capital. And it was a great career step for me, just in terms of both AUM, right? Investment strategy was more multifaceted. So Zach and I had been like dabbling in real estate to that point. This was 2021, so made the transition in 18, moved in 21. Zach and I first started looking at deals in like 2016, so I had a fair breadth of real estate, but I really didn't get into institutional, more private equity structuring style real estate until I made the shift to Houston in 2021 through another family office with a large private equity focus, which is general private equity, which is why I was hired. But as I was in sort of the junior investor role, associate role on the private equity team, expressed a lot of interest in doing more of the real estate side of the house, and then effectively kind of shifted into more of I would call like an asset manager role for the family, who's invested across, again, like a number of different private asset classes, everything from being a small LP into larger real estate funds and other private equity funds to, large checks as control investors or direct investors into big private equity platforms, real estate platforms, and other private equity platforms.
Man, that's sick. So how large is that team with Germano Capital, and like how did you integrate yourself there? Being a junior analyst, and then that's a pretty big jump, like going right into real estate. I'm going to be this analyst. I'm kind of taking over this side.
It's funny. I went from what I felt like was a more entrepreneurial group in Dallas, where we didn't really have any direct report boss. Like there was no
hustling.
There wasn't as many investment, like an institutional structure, right? Like we sort of had an investment committee, but it was, not nearly modeled after what you would see more on the institutional investment side. So I went from what I felt like was kind of like a bootstrapped executive to a more traditional oversight as a starter, as an associate. So in some regard, like took a step down from a leadership perspective, but was held to a much higher standard from an analytical or an investment perspective as a true associate. So initially, my value add to the team was similar to what my value add approach was to the first group, in that they were building a private equity team and needed support on somebody who could like help source deals, evaluate deals, and close deals, which for big funds, those are all kind of different roles until you get more senior.
Mm-hmm.
So initially when I started, it was, hey, like you've actually talked to brokers and middle market investment banks and have closed some things, and like you've got the raw skills there, and we'll help you refine your technical skills on putting together things for the investment committee and thinking about more detailed investment thesis and all of that, right? So the expectation or the transition, I think there were plenty of things going for me to make that pivot. And then as I got into it, I still enjoyed my time investing directly into operating companies and making those control buyouts in the private equity team. But, as I moved into the broader asset management role, where I was really kind of one-on-one, which included the real estate investments, a lot of that was more, say, just natural trust through the principal of the office. So the actual family, it was a first-gen entrepreneur who was still running, who started the family office and still runs his main private operating business that was the source of the wealth and the capital that we were investing. I think the transition happened mostly through the relationship that I built with that individual. Kind of became the go-to, like, chase a problem, right? Clean up the balance sheet. I would say more figuratively, right? By clean up the balance sheet, is we've got all these positions of different investments. When's the last time we talked to this person that we have a few $1 million with? Like, somebody should probably be doing that. And that was maybe more the military training in me. I saw an issue. I was asked to do one thing, and then as I did that one thing well, I continued to try to just support where I could. And it was, for me, it was more fulfilling, more engaging. I felt like instead of just being more that typical associate where you're receiving deals, you're running models, you're putting together pitch decks, like shifting out of that and back into a role where I was more directly interacting with other fund managers, other operators. That is really what I enjoyed more. And it also helped to reaffirm my ultimate ambition, which was to eventually step away and be one of those, right? Be one of those GPs on the other end, or developers or business owners, right? So I think it helped, and also having a closer relationship with the principal, with the gentleman who started the business that he still owns, and the owner and founder of the family office. It's like you get to that point. Because you got to make the leap, right? There's plenty of people that make bukus of money being investors in known private equity firms, or family offices, or you name it. But if you want to leave a lasting impact, I always had the ambition to want to do something myself. And Zach was of the same alignment. So kind of reinforced the ultimate goal, which was at some point to kind of step out and focus on my own business.
Right. So how did the company Southern Venture Partners come together with you and Zach, and what niche did you guys set out to fill?
It started like most real estate on the single family side, cutting our teeth. Zach was a builder engineer. He was doing heavy rehabs, building a little rental portfolio, got into flips, eventually got into some small multifamily. And then right about COVID era, we had been always brainstorming on, hey, how do we take what you've done, take what I've done, marry the investment with the construction and engineering and the know-how. How do we take the next step? I think the natural next step for most people is like a friends and family multifamily deal.
Mm-hmm.
So that's what we were trying to do during COVID. And, again, we're both analytical guys. So like there's a world where, the call it $10 million multifamily deals, where it's very much like Main Street investors that are out chasing these local kind of tertiary market multifamily deals, value add, like we were looking for value add multifamily deals. But as we were underwriting these things, we could never close the bid ask spread. I mean, with rates at all-time lows and multifamily continuing to be a very hot asset class during COVID, we just could never align with what the market was asking, right? We just couldn't. Our pricing was way off, and we would never like overpay for a pro forma post value add deal at close when not a single hammer had been swung yet. That just wasn't going to be a deal that we were ever going to get our heads around. And a lot of people in the market were willing to pay up at that point. So,
and some of those people got clapped later on. So, there's drawbacks. Like, you guys didn't pull the trigger, but you also didn't pay the consequences of overpaying.
Right. And so that left us with, all right, well, we want to keep taking swings. How do we grow? What do we do? What do we focus on? Zach continued to take on some single family assets that just got in worse and worse shape. So things that nobody else would touch. Ended up doing a couple of historic homes, single family historic homes, restoring those and then selling them as flips. About the same time, we were introduced to another veteran networking group about historic tax credits and historic buildings. You can buy those for plenty cheap in a lot of small towns in Georgia. Not many people are willing to take on projects like that. And so we decided it would be a great test case for us to buy our first commercial building in a town that was adjacent to where Zach was living at the time and in an area of the state where he grew up. So we knew like we had some asset control there where we felt like we could be on site enough to see the project. And, it was, high dollar for us at the time, but comparatively to the world of other real estate assets, it was cheap. Like, it was pennies compared to the scale of some other things that you could do. So like from a risk perspective, we felt like we weren't betting the farm on doing our first historic deal. So we literally bought a building without ever having done much research on historic preservation or historic tax credits beyond just maybe a phone call or two with this other investor and some Google research. But knew we wanted to. We'd had some success with this on the single family side of the house with the historic deals, and wanted to figure out a way to like make a model work. Say we closed on that first building in the summer of 21. We certainly weren't anticipating, rates to do what they did over the period of 2021 to the fall of 23 or January of 23 when we delivered the building, which, thankfully we are pretty conservative underwriters, and the deal was still able to work as we went through that redevelopment. But that was, that was not something we had on the bingo card doing our first historic deal.
No, definitely. I think for those listeners that didn't catch his episode, you guys were at the academy at the same time, right?
Yes.
Okay, so let's talk a little bit about your friendship and turning that to a partnership, and then kind of also how you're able to manage this business in partnership together, not actually living in that same town. Because when we had him on, he was telling us some of these deals are 2 hours away. He's like, there's long, rural roads between where I live to the next opportunity for these historic builds where we can get these credits, and there's a lot of value add. I love what you guys did, making like small apartments, and they're all first class. If you guys haven't seen, definitely check out everything that they're doing and what they're working on. If you just want to kind of do it on where people can find you, and then just take us through that timeline of how you guys met, which we touched on, and then how you guys are working these markets without being in them.
Yeah. So we were in fall semester, freshman year, Spanish class together as dualies at the Air Force Academy. I think we ended up getting grouped in one of those, like it was a small table group setting or something, and you all kick around each of your language modules. And Zach was from a small town. I grew up in a small town, LaGrange. It was like week one where you put together hey, tell us about your family, your interests in a 4-page PowerPoint, and do the whole thing in Spanish. Both had a little bit stronger accents at the time. One, being from small towns. Two, I think our slideshows very much mimicked each other. There was probably a dead animal or a fish and a farm, and plenty of family pictures and maybe high school football photos, right? So it's like, this is probably a guy I can get along with, and just stay. I mean, we ended up having made other friends, over the course of the 4 years, and somehow always found ourselves overlapping with the same friend groups. And then by our senior year, we were spending a lot more time together, and both ultimately had the ambition that we wanted to do. We were proud to serve. We were grateful for being at the academy, given our humble roots and background, but always both had an interest in business and finance. We didn't know where it would lead. We didn't know real estate would ultimately be where we ended up, but knew that at some point we were going to do something together. We had overlapping deployments. My first deployment and his first deployment in 15-16. That gives you a good time you've got some downtime to learn something new, start a new skill, what have you. So we both did our best to brush up on just general finance and investing and real estate. And Zach got heavy into the podcast game. I think Bigger Pockets was doing its thing. It still are, but it was the early days of Bigger Pockets. And I think he, every episode, right, from start to finish, he hit them all. In real estate, just, I don't know who said it, but the beautiful thing about real estate versus other investment asset classes is, your personal credit can get you somewhere. It matters. You can get leverage. It's really hard to go to a bank and ask for a loan to do a private equity deal, right? If you've never done it before. But if you've got decent credit, a little bit of money, like you can go do a real estate deal as an average retail investor, right? A meaningful real estate deal. And so we used those relationships, right? We were from the first flip all the way through current day. We've only been able to do what we've done because we've got good lenders. And that was, I think, the accelerant to focus more on real estate. Not having a whole lot of cash or equity ourselves, we were able to build some relationships with some lenders who had some faith in us, and that kind of helped us build the foundation. So I think the next part of the question was more on the historic assets specifically, right? And
and how you guys are managing them.
Yeah.
Not actually being on site, because Zach made it like he's like, oh yeah, it's just like an hour and 40 minutes away.
Well, I'll tell you.
Too, if anyone wants to catch Zach's episode, it was episode 49. So if anyone wants to go back and listen to that one, highly recommend it. He was so great that we had to get his partner on.
Yeah,
it's awesome.
There's parts of Houston that take an hour to get across, right, from
Sure.
point to point. So it never the area that we're in now in Middle Georgia, we kind of cover a 4 or 5 county area, but having to hop an hour or so between places, normally not a huge deal. Now we try to avoid things that if you had to be on site more than once a week that are 6 hours or 7 hours away, that gets a little bit tougher. We're not quite built for that yet, but we kind of split the house, so to speak, in that after we did our first historic deal, I stepped back and analyzed, like, where does this investment strategy best fit? Like, what investor group, like who should be doing these? Like, what's the way to really scale this? And as I dissected our first deal, it seemed apparent to me that the best investor for this is a guy like the guy I was working for in Jumana. And we had a pretty open like investment idea sharing group at Jumana, or just open forum. So you could pitch anything. I'm not saying that it would necessarily get done, but you could pitch anything. And so as we dissected our first deal, Zach and I were both like, hey, we're going to do this on our own at some point. We should really take the time to break this down in a way that is institutional. Like, let's do the homework. Let's build the strategy, build the financial models, put the effort into a formal pitch, and at the very least, see if your principal might be interested in doing something like this. Now, I'll caveat with, we were not a real estate first investment platform, and I knew that going in, and we had a ton of equity investments in other real estate managers. So it was never really a priority to run our own real estate strategy, but I viewed it and still view this as more of a tax mitigation strategy for the right investor profile. And so, we did the homework, put together a strategy, did some forecasting, kind of built an entire, here's how we would do it. Here's what we would do. Here's how we would do it. Here's where we would play. Here's how we would win. Here's a 1-year plan. Here's a 2-year plan. I mean, we're military guys, right? So we mapped the whole thing out, and there wasn't much of an appetite at the time internally to focus on that. But the upshot was, you should view the real estate as a way to access a very unique tax structure, right? And if you're somebody who has enough tax liability, which this individual did and probably still does, the tax credits can be the tax credits that are generated as a result of the real estate developments can be a really powerful tool to help them in their tax planning strategy. So this is important on your question on kind of roles and responsibilities. Well, as we put all that together and went through the process of doing the first pitch and everything, it's just kind of like, well, crap, you felt so confident about this. Like, I believe what's on this piece of paper. Now let's go do it. And so we closed on another building. We got a pipeline of a few more that we were planning to develop. And the reason I think our partnership works well is because I was able to and still focus a lot on structure, identifying an appropriate investor to marry with the development. And like, there's no reason why I necessarily, to do what I need to do, I don't have to be on site every day. You know, I don't have to be managing construction crews. I don't have to be yelling at subs or.
You need to be talking to family offices. And
Talking to family offices, trying to banks, you know, you name it. There's times that it certainly helps when we're both together. I mean, as recently as the last few months, I flew into Georgia for a rezoning hearing, right? It always helps if both partners are there and you're shaking hands with these small town government officials and making sure that they know that you're the real deal and you're going to do what you say you're going to do to restore these assets.
Man, that's I'm loaded right now. I'm just jotting everything down because I think something that happens frequently is when people get into partnerships, there's not an equal level set of responsibility and ownership. And what you guys are doing is heavily complex. A lot of people don't really when they see something zoned historical of any level, that's not the deal for me, right? So that allows you to be, you know, more selective, but then also it limits the buyer pool, so it allows you to underwrite a deal much more confidently and it be accepted because there's a lot of risk and liability for most others. And you being able to do that, and Zach being able to re-engineer. I know on his episode, again, you guys should go back and check it out. He was I think it was like he re-engineered a header to go up a level, or it was something like that, where he was literally sketching everything and putting the measurements and all of that, and talking about being on site. And I was like, man, that's so cool. And so everyone running in their own lane is what I think is making you guys really grow exponentially and be able to do these extremely cool projects.
Yeah. And what's great, like, there's easier ways to make a buck in real estate, but going back to kind of how we got into this business and what had made us at least initially successful and what we continue to try to focus on is forced equity, right? When you don't start with a lot of money, when you're not backed by some institutional capital, you got to figure out ways to get deals done. And neither of us grew up with the family lottery either, right? So we're not flush with cash to always do what we want to do. But the beautiful thing about the historic deals is you tax credit equity investor, which accounts for a really large percentage of the initial capital stack to get these deals done. That investor is usually there because they want a tax credit. They generally don't care about long-term ownership of the real estate, of the asset.
Mm-hmm.
So if you can get one done, the way that the model normally works is after a period of 5 years, when that investor accesses the credit, they roll off of the deal through a buyout option at a really favorable price to the developer. And so at the end of 5 years, and if we stretch this out, so if you multiply that over several buildings and you stretch it out over another 10 or 15 years, ideally for us, we end up owning several assets, and albeit smaller markets, but cash flowing assets in smaller markets with very little equity invested, cash equity invested of our own. And so this may get to some of the other points you all probably wanted to cover, like why this part of Georgia, like why small markets, all these red flags on people. Investors never touch these things, or rarely touch these things, unless they are the local electrician or business owner or whoever that has some cash and wants to be the king of their little kingdom. But for us, if your hold period is forever, which our ambition is to build a portfolio of these and own them and operate them for as long as it makes sense to, if the ambition is to hold them forever, and if your return profile isn't contingent on a large exit for your equity investors, then it really, in our opinion, doesn't matter where the asset is if it cash flows and performs, right? And like, there's certainly areas that we would not go into. I mean, there's dying small communities all over the U.S. where you'd be hard pressed to to fill any units at a decent price. But there's a lot of market dynamics around Middle Georgia, just like a lot of communities in the Southeast, broader metro areas that have experienced growth, whether that be through natural, macro factors. People just have more money now, especially people who for the upper kind of middle class, that have flexibility to live in some of these places and then commute to metro areas like Atlanta or Charlotte or Columbia, South Carolina, you name it. Like there's a lot of pockets of the Southeast that it may not be exponential growth, but there's been growth where maybe historically there wasn't growth before. So that was a full cycle all over the place answer. But the the tax credit side of this, I think aligns really well with just our general philosophy around how we invest and what we will invest in. And it's always, always, always some form of value add and high opportunity for forced equity.
No, I love it. And so for a traditional investor, and just super high level for some of the listeners that maybe haven't caught Zach's episode, the idea here, finding a niche market that's going to create cash flow, you're injecting capital for someone who needs tax credits, and then you're doing it for a long-term rollout play, 5+ years, where you're able to have ownership back into a cash flowing asset with low equity, a lot of work backloaded into that,
right.
but low equity,
a lot of time.
which is great. But then you get to keep an asset. You're increasing these small rural towns, which I think is like so cool. You guys have done great on your website, and just like highlighting the things that you guys are doing for these small towns, I think is so cool. But no, I mean, I love it. For the long-term play, you have low equity entry. Yes, you're allowing sweat capital, and it's what's needed, but you get to own a cash flowing asset at the end of the day, and then you're helping this other person that's going to reinvest in deals because they're probably really high net worth individuals or family offices that really have to offset for tax purposes. And so why would they not do another deal with you, right?
I mean, you can pay Uncle Sam $1, or you can pay us 80 cents and offset $1. It's kind of
exactly. Exactly. So let's talk a little bit about that, maybe to break it down on why these people would inject capital to you guys up front for tax credits on the back end, and then at a high level explaining where that matrix falls. Like if I'm spending $1 million, what does that tax credit have to be to offset that initial money for the historic rebuild?
Yeah, the market has shifted into a way, like the historic tax credit equity market is shifted in a way that really protects the investor for good reason. I mean, there's a lot of things that can happen mid-development or mid-construction. It's so, just to back up one step, there's a really robust marketplace for institutional tax credit equity, right? So if you're talking $10, $15 million plus developments with, I don't know, $5 million more of tax credits, like there are public institutions like C corporations, insurance companies, large banks. A lot of those institutions, believe it or not, have, especially the banks and the insurance companies, they have like individual W-2 roles of people. They may call them community development directors, or there's some people that are called like head of tax strategy or tax credit investing. All they do is look at tax credit deals, whether it's historic, new market tax credits, low-income housing tax credits, some of the energy tax credits. It's one of the few things that, like a bank or an insurance company, it's one of the few off-balance sheet investments that they can make in a way that lowers their tax liability without hindering their balance sheet performance, right? Like a bank and insurance company, they're always in the business of having the best possible balance sheet strength. They're not like a small business where the old man, the old lady are doing whatever they can to keep their taxes at net zero, right? Even if their P&L says one thing and their bank account says one thing about how much the business is cash flowed, there's normally a separate tax strategy that's happening in the background, and the tax return looks a lot different than the P&L.
Sure.
Banks and insurance companies don't have that privilege, right? They're highly regulated. Most of their, like for banks at every level, all of the earnings information is public, right? So there's very little that they can do or tools they have in their toolkit to kind of mitigate some of their tax liabilities. And so they tend to be very active investors in tax credit deals. For small deals like ours, small projects, you're below the threshold of this really active institutional market, just for a number of reasons, right? You could apply the same knowledge or the same justification to like investing in a real estate deal. It's going to take you just as much work to kind of underwrite and maintain compliance on a $20 million deal as it will a $2.5 or $3 million deal. And so the banks, the tax credit equity, broadly held C corporations, banks, insurance companies, they sort of stiff arm, hey, it's just not, sorry guys, we love you, we like what you're doing, but it's really not going to be worth our time to focus on some of these smaller assets. So that leaves you kind of to the world of individual investors and like smaller kind of community banks that you can build a relationship with, who may not have the tax credit investing experience, but anyway, it kind of leaves you in no man's land on the equity side. And so back to your question on like, why would somebody do this? Well, the same thing applies at an institutional level as it does down kind of the lower market, even for a small bank. Like they still have tax liabilities and there's still very few things that they can do to mitigate those.
Mm-hmm.
And so the way that structuring normally works is the equity is tiered as it comes into the deal. If you look at any publicly published materials on any of the tax credit advisory groups or some of the funds that do this, they'll tell you that there's normally no more than 25% of the total equity, committed equity, that comes in during construction. Like normally, a development deal, you get an LP, sign the commitment docs. There can be milestones as you call the equity, but by and large, like you're going to call all the equity before the project is done. In this case, if you have, assuming you lock up your tax credit commitment, by and large, only a small percentage comes in up front. The rest of the equity follows after the building is placed in service and after the tax credits are formally released. And so we're always playing this financing game of bridging the equity from the time that we start construction to finish. And a lot of that comes out of our own hide. A lot of it requires second position debt, private loans, things like that. And it's a balancing act, right? Because you got to get the project started to entice an investor. But at the same time, like you need commitments before you can personally or before you put your company too far at risk on a lot of these deals. And we haven't been the best about mitigating some of those risks, but you're early on. And if you want to make the business model work, you got to do it. I mean, we did the first deal was all of our own equity. And this second deal that hopefully we're actively building right now should finish within the next 6 months or so. But won't lie, like it's been a fight, even with my family office background and our institutional approach to doing these deals. Like placing the tax credit equity is a big lift, just because people aren't accustomed to looking at these smaller deals. So we've been fortunate that we've had a lot of good traction with some individuals, with some community banks, and we're continuing to build that investor list and network as we scale this. But yeah, to your question on structure, the investor is in the equity is in a really protected position until the point where as soon as all is a go on the tax credits and those are formally released Again, there's like a tiered process in how those get awarded.
Mm-hmm.
But the final release of the credits where somebody actually can tangibly like take that voucher, for lack of a better word, and apply it against their tax return does not happen until your building is placed in service.
Gotcha.
Wow.
Now you say I know you mentioned earlier, how you flew into that meeting with the zoning change, so that way you can, shake hands, directly. How important is it getting that buy-in from the city leaders and the communities? And then can you give us an example about, how some of your projects, gain that support on the local level?
Yeah, it's easier than a normal ground up new development. If you tell some small town, hey, I'm going to bring in a bunch of people from Atlanta and build a 5-story multifamily building on the edge of your town, that tends to not go well. Trust me, people in all the communities that we're in, plenty of developers have tried. So one, there's usually growth that's happening, and like it or not, like cities got to figure out some way to deal with it or adopt zoning and development policies that might not be in the best interest of the community. So that's one. The other is most of these assets are kind of cherished fixtures of these areas. And people, like, we've all walked into old train stations, and especially in a lot of our major cities, you see these beautiful downtown old buildings. Most all of those buildings have been supported through the use of, or redeveloped and supported with historic tax credits. Otherwise, there would just be no incentive at all to preserve those. Well, the same aesthetic, like the same, I would say, just human reaction to wanting to preserve something that's beautiful happens in small town, and even more so. So even if, like in the 3 communities that we're in, where there's ordinances against any multifamily zoning within a certain area of town, that aside, in all 3 cases now in 3 different communities, like we've been able to get variances, we've been able to get special zoning rules because we are preserving what are kind of keystone buildings and helping to support this inevitable growth in a way that solves more than one problem. You've got a need for some multifamily. You can bring in maybe some younger folks that want to live in these areas, or some workforce that wants to be there, but there's no option to be anywhere in the town other than kind of like, maybe some small rentals on the edge of town that are varying in their degree of maintenance. It's just a win-win all the way around.
Yeah, no, and not to mention you're improving something that's already there that's probably not looking in the best shape. Might even be an eyesore to a lot of people, depending.
Life safety is a thing.
Right.
Yeah.
No, yes, no. There's definitely people that want to prove that. No, that's awesome, man. So I know we're kind of coming up close to the hour. I know. Let's see. I'm gonna let Will get.
Yeah,
question.
I was pretty interested, mainly on how selective you guys are. You're talking about following growth, obviously checking certain city zoning, things where it will be easier for this preservation as opposed to ground up construction, running the numbers, seeing where that works. But how are you kind of, fine tuning that and understanding this is where we're going? We're watching X, Y, and Z market trends, job opportunity growth, the amount of people that have moved there, or the percentage of growth of people in the last, let's say, 5 years. Just talk to us a little bit, and the listeners, on what are these key indicators that are allowing you guys to structure these deals properly.
Sure. So we benefited from the first few in that we had done some flips in these counties, and so we saw the demand for single family homes of a certain price point, which gave us some early indication on like how fast those homes moved, that there is an entire potential tenant base of people that maybe being right on the borderline of being able to buy that kind of starter home. So I will say that early on it was more of we had some empirical data, just firsthand knowledge, but we didn't have the market research. Well, as we have peeled this back, there's Certainly look at population trends. And again, all the counties that we're in right now have all trended in a really good way compared to the broader state population growth average. So like as we've looked at new markets, specifically around Texas, we've started to look at a few areas. I mean, there are, I'd say we still rely a lot on the eye test, which is not at all like how we would normally approach a new market or a different real estate investment strategy. It starts with the eye test, and then we reinforce with data is the best way to explain it.
Really? You are kind of scraping data in small towns and cities.
Yeah.
These are all the buildings that were built in, boom. Like
What is the number
for historical tax credits? I think that's like our super
right
level of someone that was interested in this.
From a historic perspective,
selfishly asking these types of things, because whenever I hopped on with Zach, like I think we talked for I think we went 3 episodes, like an hour and 45 minutes or something, because it was just like I was asking a ton of questions. And on this side, trying to attack it from funding the deals is equally as interesting to me. And I'm just like, I've just been writing like 10 pages of notes so far because it's so awesome. But I think where you guys are at, you have this limited pool of buyers for small deals, but you're showcasing yourself how you guys are the best at structuring this. And I think that allows people not only to have confidence to fund these deals, but you guys are early in the stages of doing this. It's just going to be a snowball effect of growth, which is super cool. So that's why I was like, where do you start?
Yeah, I should have started there.
Like,
one of the things that we do,
25, like 100 years back, or I don't know.
Yeah, so it's a good point. Anytime there's any interest in a new market, the first thing we do is there's the National Park Service, Department of Interior sponsors. There's an ongoing data set of historic districts and individually listed historic buildings. There's also like an interactive map. I don't know that the map's not as updated as the raw data, but there's an overlay. And so if we're driving around Georgia or we're driving around, we have military friends all over the Southeast. So if we're in North Carolina or South Carolina or Texas, or someone says, hey, check out this community in Alabama. The first thing we do is we go look at our historic map and see if there's a district in place. We can pull stats on when the last tax credits were awarded to see how active the community might be in previously awarded credits. But also, sometimes it's a good sign for us to get better deals if there's not a district that's been set up yet, or if there's not been a credit awarded.
Sure.
We can buy a crappy building for much cheaper if you're in a community like Madison, Georgia, outside of Athens. Beautiful, beautiful community. Awesome historic district.
Isn't that like the largest amount of antebellum homes like in the whole country, like in one area?
Oh, I don't know, maybe.
It's like a huge historic district, right? Yeah.
It could be. But when you drive there, like if there was one it wouldn't matter what shape it was in. If there was a building that was not touched that existed in their historic district, I guarantee you the entry price would be way higher than we would be willing to pay to do a historic deal. One of the nuances around the credits is the entry price of the asset does not count toward your basis calculation for the credit. So the credit is a percentage of total development cost of your rehabilitation cost, not your total development cost. So the more you pay, kind of it really compresses your returns, or that's more equity we would have to come out of pocket for up front, because the tax credit equity is not going to pay for any of that. And so oftentimes I say like the first check is obviously to look to see if there's a district, but if there's not a district, that can be a good thing for us too. It'll take longer to get the assets listed and potentially even to set up a full district in a community. But while that's happening, we can likely still buy buildings for cheaper than we would if there were a district in place already.
And probably a little bit of less red tape to get, if you get started without there already being a district.
Yeah. And there's normally, even if there's not a district, there's always like a small town committee, a historic committee that they may have their own independent local ordinances around like what can be done to the facades of these buildings in downtown. Like there's normally some thread of somebody who's paid attention to these buildings and all these, call them your square communities, downtown square communities. So there, you've got an ally in most places that you go, and it would be apparent too, right? Like another market we really like where we're in on the single family and the multifamily side, like Warner Robins, are another example would be like Peachtree City. Those are designed metro areas. There's no historic buildings in those communities, right? So that's just an area where we like the dynamics normally, but there would never be an opportunity or very few opportunity for us to play in some of those markets, or think like suburbs of Houston or Dallas. There's a few towns that the sprawl has now connected to some of these communities that are older, or have a town that's older, and there's probably some historic assets, but all the sprawl in between likely would never be a candidate.
Right, because it's all new. What is there a hard line, or is it just what the Department of Interior's designate?
Yeah, if there's a district, there are specific parameters around it. It'll say street borders this street, and this street, and if there is a district, your quote. So there's a 3-part test at the national level, and your part 1, I think that's where any gray area is navigated, where they would say, this is the district, here's the building or the asset of interest, and the National Park Service will tell you whether or not that building is a contributing structure to the district. The other option is that there are individually listed buildings. If the buildings aren't already listed, we're kind of at a point with the National Park Service where they would really prefer, if they're going to spend the time reviewing a building, they would rather you send an application for a new district. You can do both in parallel, but feedback, because we're doing this right now in one of the communities that we're in, the feedback has generally been, all of this seems like it will have some viability in terms of historic listing, but we would prefer you not to like list this one old schoolhouse or one hospital. Like put a district together and we'll review your packages in parallel. It costs money.
Sure.
Don't get me wrong, and time, but for good reason. If you're going to put the work in, you may as well encapsulate the broader community and support additional development versus just listing the one asset.
What do the fees normally look like to do a district like that?
Most of it's through the consultant. Depends on who you're working with there. I mean,
you can give a broad range.
20 to 40 to 50. The bigger fee, which we've been really surprised by at the state level, has been like submitting the applications.
Really?
For something that's already, say your part 1 is finished, assume that either you just listed a building or a building has been deemed a contributing structure to an existing historic district. The state now is levying fees as a percentage of your total development application. So the total rehabilitation cost. And the last one was pricey. And I think the state's doing that to discourage tire kickers. They want to know that people are really serious about, you're not going to spend the time and resources to review the application. So they've increased the fees pretty significantly. And the other side of it too is the state of Georgia has had a lot of activity for historic credit applications, and mostly in Atlanta right now. There's a big development going on south of town in advance of the World Cup in 2026. They're trying to redevelop, like, I don't know what it is, 4 city blocks or something south of Mercedes-Benz Stadium, maybe more than that. And so because of that, there's been a lot of pressure on the state budget. There's an annual cap for state credits.
Yeah.
And all states have a little bit of a different program, but for Georgia, there's a $30 million state cap. And so I think they've seen both just an increase in activity at large, because deals have been tighter and people have been trying to look for creative ways to get developments done, in combination with more activity leading up to this World Cup, that I think they raised some fees to help preserve some of the budget for serious developers.
No, that makes sense. So, man, with all the experience you've had, and all your background experience, from after you leaving the academy into the private equity, what would you tell someone who's starting out today trying to do tax credit investing or redevelopment? What would that first step be that you'd recommend?
Yeah, with everything, it's start small. Do a live in flip, or like understand real estate fundamentals. And then as you kind of work your way up, with that knowledge base in hand, I would just for general life advice, assuming you can understand the dynamics of the structure, just be adaptable, because even more so than things always come up, even in like your fairway value add multifamily deal, there's always issues. But as you're approaching these really kind of advanced structures and really old buildings, be in a position where you've got time to learn. I mean, Zach and I, our first building took us almost 3 years.
Yeah.
Right? We gave ourselves room to make mistakes. If that building collapsed, which it almost did, but if that building collapsed, it wouldn't have ruined our financial well-being or future, real estate careers. So start small and, be adaptable. Like, give yourself room to make some mistakes, because you will make mistakes. And then on the
yeah, adaptable is key word. That's definitely one of the things I feel like you really got to be in real estate, especially as markets turn and things like that.
Yeah,
adaptability.
And even on the equity side, for me, it's a nonstop fight to try to get investors through the door and signed up and everything else. And if you've been around deals long enough, like, nothing's ever done until somebody wires you the first closing cash, right? And so, like, we've been, over the last year or so, we've been at closing table pretty frequently with things that we thought were done that were not done, right? And so both from a construction development side and just from the equity raise side, you got to be flexible and you adaptable, and you can't stop,
Yeah, that's great. I am kind of curious, kind of in closing here. You said the first building took 3 years, and then earlier in the former part of the conversation, you were saying it's a 5-year rollout strategy. Now, is that once you've closed? Because you had mentioned it's once it's active, right?
Yeah.
So does that push that tax credit and that mitigation for that investor now to 8 years? Is that kind of that runway pattern, or it's fine?
Yeah. So in that example, if
I
you were
remember
taking
something of a tiering process as well.
If we took outside money on that deal, that would have been a tougher path. We didn't. That's why we didn't take any outside equity. But the way that we would normally, now going forward with the model, the way we do this is we try to get the sort of the pre-development design work, our pre-construction initial development work completed, and have the project to a point where, like, we're ready to break ground before we would call any of that tax credit equity. Because the clock's going to start ticking, but the 5-year hold, so to speak, that clock doesn't start until the building is placed in service. Right. And I forget what the timeline is, but there is a time limit from the time that you apply for the credits to when you have to place the building in service.
Oh, wow.
So it can expire if you're slow.
Yeah.
Gotcha.
Yeah. I need to go back and look at what that is, but yeah, that can get,
obviously it's longer than 3 years, but
yeah. I don't know when we submitted our application for that first building. It was probably within, I don't know, closer to like within a year and a half or so from the time we finished.
Gotcha.
We just spent a lot of time like, okay, we have a building now. Like, we got to find an architect who does this. We got to research the credits. And we weren't trying to raise any outside money for the federal credits, which are the trickier ones. Our strategy the whole time was we'll use the federal credits ourselves, because I still had W-2 income and Zach had some, and we had, passive income from some other properties and things. And we had a construction company that was performing the work, but we were still billing the work. So like there was a tax liability that flowed to the even if there was no cash in our pockets, the construction company was still recognizing revenue. So there were some ways we could use the federal credit. Yeah,
of course.
Yeah. But yeah, generally, if I could pick a strategy, it's, ideally have a commitment from somebody who's got a known projected liability need. Tell them, hey, I'll call you in like 8 months. But I need to know that you're in and ready to do the next one so that I can go at risk doing my pre-construction, development planning, line out my construction financing, and be ready to go. Which I go back to the point of it's always a balance. It's a risk balance. And you got to be able to, if that falls through, you got to have a way to survive and hold the asset, backup plan, you name it, plug in new equity, and hopefully have a good Rolodex to go call on some people if that happens, which, we spent the last year and a half building. So hopefully as we're in this continued balancing act for our next developments, we've got plenty of tax equity to step in behind us.
That's awesome, man. I've really enjoyed this, learned a lot. I'm definitely going to be pinging you and bending your ear some more, because everything you're doing, just from going to the academy into the private sector, being an analyst, now running everything that you guys are doing in like such a niche market, historical, and really utilizing tax liabilities and leveraging that. I think it's all just so unique and so cool. So, man, where can everybody find you guys again? Southern Venture Partners, where
I think for better or worse, our emails are on our website, southvp.com. If you wanted to hit my email, it's Milton at SouthVP, and Zach at SouthVP. But yeah, check out the website. LinkedIn page is a work in progress. I would have liked that to be more consistent with showing all of the great construction progress updates, but still wearing a lot of hats right now. So at some point we'll have a more active social media page on LinkedIn, but for now, email is the best way to roll.
Awesome, man.
Well, definitely check out the Milt and his partner Zach at southvp.com. They are definitely doing big things in this niche market, and very exciting to see. And then definitely tune into our next episode. Follow us on YouTube at the Elite Real Estate Podcast, and then check out our website, theeliterealestatepodcast.com. If anyone has a lot they're trying to sell in the Escambia County area, Will and I are actively buying buildable lots all around Escambia County. So please drop those lots into our text box on the website at theeliterealestatepodcast.com. But anything else before we close out, Will?
Good. Just another round of thank yous. Appreciate your time. Appreciate your service. And, man, just keep us up to date on all your new projects, man. That's awesome.
Yeah, Milt, thank you so much for coming on the show.
Thank you both, guys. Appreciate it.